The Precision Instrument for Cash, a comprehensive guide to the US Treasury 3-month bill ETF, TBIL. As of February 3, 2026, the US Treasury 3-month bill ETF, ticker TBIL, has carved out a unique niche in the financial world. While broader bond funds like BND cover thousands of different debts, and cash alternative funds like SGOV cast a wider net across the 0 to 3-month spectrum, TBIL is a single bond specialist. It is designed to behave almost exactly like the most current 3-month US Treasury bill, but with the ease of a stock you can buy and sell in seconds. For an investor today, TBIL is the sniper rifle of cash management. It doesn't just offer safety, it offers targeted exposure to a specific point on the yield curve. This guide explains the on-the-run strategy that sets TBIL apart, the tax advantages that save you money at the state level, and why this fund is a favorite for those who want to equitize their cash. 1. What is TBIL, the on-the-run strategy? TBIL, issued by FM Investments, tracks the Bloomberg US Treasury Bellwether 3-month total return index. The term bellwether is key here. It refers to the most recently issued or on-the-run Treasury bill. How the fund operates. Unlike other short-term ETFs that hold a ladder of various bills maturing at different times, TBIL is ultra-focused. The weekly roll. Every week, the U.S. Treasury auctions new 3-month bills. As soon as a new bill is issued, TBIL sells the old one and buys the new one. Maximum liquidity. By always holding the most recently auctioned bill, TBIL stays in the most liquid part of the bond market. Pure exposure. If you hear on the news that the 3-month Treasury yield is 4.4%, TBIL is the fund that will most closely mirror that exact number, minus its small management fee. 2. Financial profile. Yield and performance in 2026. In the early months of 2026, the interest rate environment has stabilized, making TBIL an attractive anchor for conservative portfolios. Key statistics as of February 3, 2026. Stock price, somewhere around $50. The fund is designed to stay near this par value, though it fluctuates slightly due to accrued interest. SEC yield, somewhere around 4.1 to 4.3%. This represents the current income generated by the underlying Treasury bill. Expense ratio, 0.15%. For every $10,000 you invest, you pay $15 per year in management fees. While slightly higher than SGOV, 0.09%, TBIL's higher fee pays for the active rolling of the single most current bill. Assets under management, AUM, somewhere around $6.3 billion. While smaller than the massive iShares or Vanguard funds, TBIL has enough scale to ensure tight bid-ask spreads, meaning you won't lose much money when buying or selling. 3. The monthly dividend cycle, equitizing the yield. One of the primary reasons investors choose TBIL over buying actual Treasury bills from the government is the dividend structure. The benefit of monthly payouts. If you buy a physical 3-month Treasury bill, you don't get a check every month. Instead, you buy it at a discount, i.e. you pay $9,800 for a $10,000 bill, and wait 90 days for the full payout. TBIL equitizes this process. It collects the interest daily and pays it out to you as a monthly cash dividend. In 2026, TBIL has consistently paid roughly 0.16 to 0.17 cents per share every month. This creates a predictable stream of income that is easier to manage than a ladder of individual bonds. The ex-dividend price action. Just like other cash-like ETFs, TBIL's price follows a sawtooth pattern. It creeps up towards $50.18 over the course of the month as interest builds, then drops back to $50.00 immediately after the dividend is paid. Understanding this prevents sticker shock when you see a 0.3% price drop at the start of a new month. The State Tax Shield, why T-bill beats HISAs. For many investors, the real magic of T-bill isn't the interest rate, it's the tax treatment. Federal versus state taxation. Savings accounts and CDs. If you earn $1,000 in interest from a bank, you owe federal income tax and state income tax. T-bill, Treasury bills. Because T-bill invests exclusively in U.S. government debt, the income it produces is exempt from state and local taxes. The effective yield advantage. If you live in a high-tax state like California or New York with a 10% state tax rate, a 4.2% yield from T-bill is actually worth more than a 4.5% yield from a standard savings account. After state taxes, the savings account yield drops to 4.05%, while T-bill stays at 4.2%. In 2026, savvy investors use T-bill specifically to shield their cash from the state tax collector. 5. T-bill versus SGOV. Which cash hub is right for you? While T-bill and SGOV, iShares 0 to 3-month Treasury, are often compared, they serve slightly different masters. SGOV, the generalist. SGOV holds a broader range of bills maturing anywhere from 1 day to 90 days. It is slightly cheaper, 0.09% fee, and is widely considered the standard for parking cash. TBIL, the specialist. TBIL is for the investor who wants the highest possible precision. Because it only holds the most recent on-the-run bill, it reacts faster to changes in the weekly Treasury auctions. If you are a trader using Treasuries to hedge a specific position, or simply want the most current yield possible, TBIL is the superior choice. Image illustrating the portfolio composition of TBIL, 100% focused on a single on-the-run maturity, versus SGOV, a diverse ladder of multiple maturities, highlighting the difference between targeted and broad cash management. 6. Risks and reality checks. No investment is 100% risk-free, even one backed by the full faith and credit of the U.S. government. Interest rate risk, minimal but present. Because the duration is so short, 3 months, the price of T-bill is very stable. However, if the Federal Reserve were to shock the market with a massive 1% rate hike in a single day, the price of T-bill could dip slightly, perhaps 0.2% to 0.3%, until the fund rolls into the new, higher-yielding bill. Opportunity cost. In a bull market where stocks are returning 15 or 20%, holding too much T-bill can be a drag on your long-term wealth. T-bill is for your safety money, not your growth money. The Fed pivot risk. T-bill's yield is a floating target. If the Fed decides to aggressively cut rates in late 2026 to stimulate the economy, your monthly T-bill check will shrink almost immediately. 7. Strategy. How to build with T-bills in 2026. For most retail investors, T-bill acts as the core liquidity layer of their portfolio. The Emergency Fund 2.0. Instead of letting $20,000 sit in a big bank savings account earning 0.01%, investors put that money into T-bill. It remains liquid. You can sell it any day the stock market is open, but it earns 400 times more interest. The waiting room. If you have just sold a house or received a bonus and aren't sure where to invest it yet, T-bill is the perfect waiting room. You get paid to sit on the sidelines while you wait for a better entry point in the stock or real estate markets. The retirement income supplement. For retirees, holding 1 to 2 years of living expenses in T-bill provides peace of mind. If the stock market crashes, they can draw from their T-bill bucket without being forced to sell their stocks at the bottom. Conclusion. Precision cash management for the modern investor. The U.S. Treasury 3-month bill ETF, T-bill, has brought institutional-grade Treasury trading to the everyday brokerage account. By focusing exclusively on the on-the-run 3-month bill, it provides a level of purity and transparency that traditional money market funds often lack. The verdict. If you are looking for a highly liquid, state tax-exempt, and ultra-precise way to earn the current market rate on your cash, T-bill is an essential tool. It represents the Goldilocks of the bond world, not too long, not too broad, but just right for the investor who values safety above all else.